Hello and welcome to another episode of Nothing Ventured in the News. This month, June 2026, it feels like a bit of a continuation from prior months, but frankly, it's not just another AI month. It really is a month that the market has shown us in public who it is that gets paid. And the big news, let's face it, of the month is SpaceX's IPO. It is the defining story for June and possibly the entire year. June finally gave the venture ecosystem what it has been talking about for months, which is a truly massive public market event. SpaceX is not just an IPO story, it is a liquidity story, a valuation story, and a stock as currency story. Reuters reported that it was targeting a record $75 billion IPO at $135 a share, and the roadshow was expected to be intense with a huge amount of demand. They then reported that the offering priced at $135, raising $75 billion, as I mentioned, really valued SpaceX at close to $1.8 trillion. Yes, that's $1.8 trillion. But the stock then surged on debut and pushed the company's value well above $2 trillion. They reported proceeds rose to $85.7 billion after the green shoe was exercised. And they reported that SpaceX had agreed to buy Anysphere, the maker of Cursor, for $60 billion in stock just days after the IPO. So this is not just a big exit, right? We all knew this was going to happen. What it is proof that public markets are still rewarding category-defining private giants in a way that the rest of venture can rarely access. And the Cursor deal actually matters as much as the IPO because it shows what happens when a newly public giant suddenly has hugely valued stock to use as acquisition currency. So June is a month that the venture concentration story became public market reality. And there are some questions that we do need to think about. Does SpaceX's IPO reopen that IPO window, or does it simply prove that only the absolute elite can get out cleanly? And if rich public stock becomes acquisition currency, who gets consolidated next? And with SpaceX having gone pop, is this a signal for the ecosystem, or is it really an outlier that makes everyone else just look a heck of a lot smaller? Now, I don't think that SpaceX is proof that exits are broadly fixed and back, but it is proof that the very top can still clear spectacularly. It would be incorrect to say that the IPO market is fully back. The market is still paying up for rare, unavoidable assets. And once you accept that June was defined by this giant winner clearing publicly, the next question is whether the underlying venture market has actually changed. Newsflash, for the most part, it really hasn't, because the barbell still holds. All that's happened is that June has made it a hell of a lot more obvious. The market is still barbelled. A few giant companies dominate dollars and attention. Early stage still works for disciplined specialists, and the middle remains thin. SVB's 2026 market note says that venture has this clear barbell effect, and we've talked about it a huge amount in previous episodes. Giant late-stage rounds at one end, disciplined pre-consensus early-stage investing at the other, and a very hollowed-out middle. Again, as we reported last month, JP Morgan's Q1 2026 VC update says that significant AI mega rounds have reshaped venture investment, whilst geopolitical risks have clouded the outlook. PitchBook and MVCA's Q1 26 Venture Monitor said that US venture deal value hit $267.2 billion and exit value hit $347.3 billion. And if you remember those numbers, or they sound familiar, we did talk about them in the last news episode in May. And again, as we reported then, excluding the 5 largest deals and exits, those numbers get cut by 73.2% and 86.6%. So June is not a new structure, but it is clearer proof of the old or existing one. The market is active, but it is not broad. Record totals are real, but they are heavily, and I mean heavily, distorted by a handful of giant events. And we have more of those events, presumably set to come, with both Anthropic and OpenAI talking about IPOing later this year. But the middle is still the hardest place to live. Too big to be a scrappy pre-consensus seed bet, too small to command giant rounds or clean exits. And again, we have to ask ourselves, if the biggest deals and exits are stripped out, how healthy is the market in reality? And does specialization become mandatory when the middle stops working? And this is a theme that we've played on a huge amount with our guests on the podcast over the last couple of months. And what we have seen is this kind of restructuring of venture towards far more specialist activity as opposed to the generalist software investing we saw in the preceding 5 to 10 years. And are we still talking about one venture market, actually, or several separate ones with different and disparate rules? Now, again, we don't want to just repeat the fact that the market is uneven and has barbelled. But what I really do want to emphasize is the fact that June shows why it matters. SpaceX at the top, a lot of pressure in the middle, and selective opportunity lower down. That thin middle is why some of the more interesting June rounds are not mega lab stories at all. In fact, they are highly specific tools and infrastructure bets. So what is the most underreported story of June? I would say it is boring AI infrastructure that still gets paid. Not all the interesting money in June went into model labs. A lot of it went into tools that make AI cheaper, safer, or even more usable inside real companies. And in fact, if you've been paying attention, a lot of the podcasts that we've done recently have touched on some of the difficulties with these labs as tokens start scaling and the costs of those tokens start scaling, and the sort of difficulties that some public and private companies have now been reporting in terms of usage and costs. And it does beg the question whether there may be some form of pullback as CFOs and others start looking at these numbers in far more detail and with a lot more scrutiny. But Reuters reported on the 17th of June that GenSpark AI raised $100 million at a $2.6 billion valuation for workplace productivity AI tools. On the 18th, they reported Architect Labs had raised $24 million in seed funding to use AI to speed up custom chip design and challenge incumbents like Broadcom and Marvell. The April context from Reuters actually still matters here. Google had put AI agents at the heart of its enterprise push, which helps explain why June money kept flowing into developer and infrastructure and enterprise tools rather than only into foundational models. The more interesting AI market is often the boring one. It's the old picks and shovels story again and again. Cost control, chip design, productivity, developer tools, and enterprise workflows are where adoption actually translates into revenue. And these are pick and shovel bets, as I just mentioned. They do not need to become the model layer in order to matter. And of course, we have seen this month the US government restricting access to some of these foundational models to non-US actors. So this is also a margin story, because if companies can cut design time, compute waste, or workflow friction, that is a much cleaner value proposition than generic AI hype. So we have to ask ourselves, is the most investable AI now the unsexy AI? And where does value actually settle? In the model, the workflow, the chip, or the orchestration layer that sits on top? And are these businesses more durable because they are tied to operational pain rather than novelty? And interestingly, I had a conversation with a founder recently who had raised a seed round in a very physical product-orientated business. And I did pose the question, is AI being built into your operations, even though it isn't a core part of the commercial nature of the business? And I think this is the story that is going to continue to play out over the coming months, if not years. So it isn't like June has made it sound that all frontier labs are all the time. We really do have this infrastructure layer sitting underneath. But once you move beyond the boring infrastructure, the next place that June gets interesting is where venture starts funding physical systems once again. That frontier capital is widening into these physical systems. And June was not just about software. And in fact, I would argue that over the last 6 to 12 months, if not 24, it has moved broadly away from, traditional SaaS into more physical atoms-based businesses. June was a month about fusion, world models, power, chips, and physical AI infrastructure. On the 4th of June, Reuters reported Helion raised $465 million at a $15.5 billion valuation, nearly tripling its value from early 2025. On the 16th, they reported that Helion had become the first US fusion energy firm to clear the relevant regulatory licenses, giving the story far more substance than a pure funding headline. On the 17th, Reuters reported that Odyssey had raised a $310 million Series B financing at a $1.45 billion valuation to build advanced world model and simulation systems. And on the 11th, Reuters reported that KKR had launched Helix Digital Infrastructure with more than $10 billion of committed capital to fund AI infrastructure, with backing from NVIDIA, Vistra, and the Kuwait Investment Authority. So this is physical AI, not just digital AI. Power, chips, simulation, and infrastructure are where the bottlenecks now sit. The KKR Helix story matters because private capital is moving downstream into the pipes, not just the apps. June suggests that venture and growth capital are widening into systems that are harder to build, slower to scale, but strategically very much harder to ignore. So what are the questions that this leaves us with? Well, the first is whether or not investors are paying for defensibility again, even if it means longer time horizons. And we have, again, talked about this extensively on the podcast. Does the next AI wave belong as much to power and infrastructure as it does to models and apps? And is world model funding a real new category, or still an expensive, speculative side quest? So we really do have to point out that this does not mean that all frontier bets are equivalent. Fusion, simulation, and AI infrastructure have very different timelines and risk profiles. But the common point between all of them is that hard systems are back in the funding conversation because physical bottlenecks are now obvious. And I've talked about it again and again. In an AI-dominated world, the moats that we have to play with have actually come down to very few, and it is distribution, proprietary data, and hardware. Now, all of that sounds exciting, but the money still has to come back out. And that is where June remains brutally selective, because liquidity is still the real issue. SpaceX is very much the exception, not the cure. June's giant IPO does not cancel the deeper liquidity problem, it just throws it into sharper relief. Preqin's VC outlook says that the exit environment improved in 2025, but GPs remain under pressure to increase distributions, and secondaries and alternative liquidity tools are becoming more central. And this is playing out in the broader venture ecosystem, where we are seeing funds raising Fund 3 or Fund 4 really starting to struggle to get to those numbers because LPs who have traditionally backed them are still waiting to see outcomes from prior funds. On the 2nd of June, Preqin said that secondaries had reached $220 billion in 2025 and could hit a record $250 billion in 2026. On the 11th, Reuters reported from Berlin that weak cash distributions are making it harder for private equity firms to raise new money. And again, as I said, that remains true of venture as well. Bain said that firms are holding assets for around 7 years, and the backlog of unsold companies has reached about 33,000 across private markets. JP Morgan's VC update says that geopolitical risks and exit uncertainty still cloud the outlook, even as AI mega rounds continue. So this is really the core contradiction, if I can put it that way, of June. One monster IPO really screams success, whilst the rest of private markets still complain about trapped capital. Secondaries are no longer a side story. They are becoming part of the main plumbing now. But again, it begs the question, what happens if that dries up as well? SpaceX is exactly the kind of exit that makes the backlog look worse, not better, because it highlights how few companies can actually do it. So again, we must ask ourselves, are secondaries solving the liquidity problem, or are they just helping everyone pretend that it is solved? And does a blockbuster IPO improve confidence or simply raise the bar for everyone else? And fundamentally, what does winning look like now? IPO, M&A, secondaries, or just staying alive long enough to be liquid on your own terms? And I am certainly hearing of a number of businesses that raised last in 2021, 2022, who are grappling with those exact questions. So June did not fix liquidity. It absolutely didn't. SpaceX is really that spectacular exit at the top that contrasts the structural pressure almost everywhere else. So June is not merely another AI month. It is the month that the market showed us in public who gets paid and who still has to wait. June 2026 matters because it showed that the venture power law is not just a private market phenomenon anymore. The biggest names can clear publicly, use stock to consolidate, and pull capital into physical infrastructure, whilst everyone else still lives with a thin middle and a hard liquidity problem. So as we head into the summer, I think it's worth thinking about where venture goes from here. In the meantime, this has been Nothing Ventured News for June 2026 with me, Arish Shah. Hope you enjoyed it, and remember, stay liquid.